Welcome, everyone. Thanks for joining us. We're just going to get started shortly. But David, over to you.
Thanks, Stephen. Thanks, everyone, for joining this webinar, Angel Connect. We'll give it a few minutes before we get started for real, but very happy that we have an absolute stellar panel today to speak with us about investments gone wrong. Sorry for the background noise. And in the meantime, yeah, please do sort of say hello in the chat. Just drop your name, where you're from. I trust there'll be a lot of familiar people in the session, alumni from the academy and other friends from the show. So please take a moment and drop your name in the chat so we know who's online, so everyone knows who's online. We'll give it one more minute and then we'll start. We'll start for real. How are you doing, Stephen? How's the weather in Nairobi today?
We're just about to start the rainy season. I was just telling
Right.
Tarek earlier. So it's getting a bit colder, not chilly. It's still 25 degrees, but for Nairobi, that's cold. But good weather overall. The rains are
Very
not
good.
good because, yeah.
How's Alexandria? Perfect as always.
Alexandria, oh yeah. So I'm in Cairo right now, most of the time.
What are you doing in Cairo?
Yep, moved to Cairo. I've been always going back and forth, but now more time in Cairo than Alex. But weather's nice. Weather's nice actually these days.
Okay. I thought by now you would have escaped the hectic life and settled down in the villa overlooking the Mediterranean.
Yeah, that's always the dream. That's always the dream. But just keep the vision.
Very good. Keep the dream alive. Okay, as just we get started, Stephen, if you can, do you want me to intro Steve, or you want to start and I go to?
Go for it, David. Go for it. Let me just jump to the next slide. Okay,
very good.
Cool.
So thanks everyone for joining this Angel Connect, our give and take quarterly event that we host for the alumni of the African Angel Academy. As always, we try and bring you relevant conversations, relevant speakers to have very informal sessions where we talk about what we hope to be very sort of timely topics. Very happy with today, where we're going to speak about investments gone wrong, how to signal those, how to manage it, and we've been able to find three friends of the family and we think people that have a great experience to speak about the topic. We have Kristin Wilson, who's an alumni, Lewam, Kefela from Partech, and Tarek Kady, who's been an angel investor for many years with the Alexandria Angels and the Angel Group overlooking the Mediterranean, from all sides of the Mediterranean. You'll have a chance maybe to say a few words about your background, what you've done so far, and your experience in investing. A very short sort of agenda for today. But like I said, so Angel Connect, obviously, and then so a short agenda for today. A few words about the Academy for those of you who are less familiar with the work that we do. The bulk of the session today is obviously the panel discussion and the Q&A. As always, we try to keep this as informal as possible, meaning that everyone in the call should feel invited to join the conversation, share your experience. You can drop a question in the chat. We have a team that's monitoring that. You can just raise your hand and we'll try to loop you into the conversation. But the whole point of these sessions is very much for everyone to join the conversation. I hope that everyone feels invited. Great. So a few words about the African Angel Academy. So Stephen Gugu sitting in Nairobi, Alexandra Fraser out of Cape Town, and myself have always been involved in the sort of early stage investment space, angel investing. We've done a lot of work with ABAN, the African Business Angel Network. And Stephen is one of the founders of an angel network in Nairobi called the Victoria Angels. Alexandra, who's not with us today, is one of the co-founders of an angel network in South Africa called the Dazzle Angels, female first. And back in around 2019, 2020, we had the opportunity to applying for some funding to build a designated program specifically looking at education. And that became the African Angel Academy. So we've been up and running since about 2010-ish. We've done 10 cohorts. So the way that we structured the program initially was cohort style. We bring together a group of people and then take them through a program. And of course, over the years, we've really sort of fine-tuned the program, added new modules, cleaned up some of the old stuff, and organized, many other events along the way. I'm very proud of the work that we've done, reaching out to 700 plus angels. And we all believe that it's important to still mobilize much more capital on the continent. We all believe that it's very relevant, and that for early stage investors, for early founders, the best investor is probably someone who lives down the street, who understands the value you create locally, who, sorry, I'm bezig, jongens. Ergens anders spelen, Jacobi. Bye-bye. Sorry, guys. So, we all believe in the value of angel investing. So we're quite passionate about this program and our ability to bring more people along the journey and to train people. We've had 48% women participation. I would say 50%. I would say more than 50% actually, but I guess it's 48%. Any other questions? Of course, we have a website. You can reach out to any of us, and we can sort of help you and navigate your way. And then the two main organizations behind the program, which on the next slide is Viridian, which is the team from Alexandra in Cape Town, and Biban, which is the team that Stephen runs out of Nairobi. But other than that, it's a very sort of Pan-African family. But these two organizations have been in the lead from day zero. Then I'd like to hand over to Fiona, who is our still relatively newish program manager, to say a few words about the upcoming program, which will be our cohort 11. Fiona, we have you in the building.
Yes, David, I'm right here. Thank you very much for that incredible introduction. Particularly for one, I'm super excited about the coming cohort, which we have quite the interest. It's a 13-week program that is self-paced and includes live interactive sessions led by top African angel investors, as well as industry experts. You're looking to really dive into getting actionable insights on sourcing, valuating, understanding all practicalities and technicalities of the angel investing journey. We do have an ongoing call for applications that's closing on the 31st of March, so fairly soon. Please scan the link over there. I'll also include it in the chat below a little bit later so that you can interact with it and apply. Quick note, once you're accepted to the program and you do pay for the program in within 24 hours, the program cost is $1,000. If you do pay for the program, you're eligible for a 15% discount if you pay within 24 hours. So we're really looking forward to seeing all the amazing aspiring angel investors, guys next door to join the program if you're really looking to make an impact in the ecosystem. Moving on, we additionally do have an ongoing call for applications for the Angel Leads program. A little bit about the Angel Leads program. It is a program supported by the UK-Kenya Tech Hub, and it's designed to strengthen the angel investing ecosystem in Kenya by equipping investors with the necessary knowledge, networks, and structures to make informed early stage investments. The program will focus on engaging investment groups, organizations that support informal investment groups. Here in Kenya, we term them as chamas and the likes. And also solo investors to really encourage them to participate as representatives of the group. So it will be targeted in terms of the focus. It is a Kenya-only program focusing on Nairobi, Mombasa, Kisumu, and Eldoret. The call for applications for this is running till the 4th of April, and we look forward to having anyone and everyone who's keen to kickstart their investment journey or lead an angel group join the program. I think I'll hand it over to David. Back to you.
Right.
No,
Thanks a
no,
lot,
actually,
Fiona.
oh,
Yeah.
okay,
No,
David.
Stephen, it's all yours. You can, I think you can take it from here. Thanks a lot.
Okay, cool. Thank you, David. Thank you, Fiona. And thank you, everybody, for joining us. Stephen Gugu, one of the lead facilitators at the Africa Angel Academy, and I'm going to be facilitating today's conversation. I want to make sure we get as much juice out of the session. So I will just ask the three amazing speakers who've taken time out to come and share some thoughts to quickly just intro themselves, and then we can jump into the conversation. It is a topical conversation. We have an angel network in Nairobi, the Victoria Business Angels Network, which has made a number of investments. And certainly this is one of the topics we are discussing today. When you speak to other angels, owing to the funding winter we've been talking about, this conversation keeps popping up. And so I think it's going to be an awesome conversation. So I will invite, probably let's start with Lewam to do a just quick intro, and then we move on to Kristin and then Tarek, and then we can jump into the conversation. Lewam, over to you.
Sure. Hi, everyone. Great to be here with all of you today. I'm Lewam Kefela. I'm a principal at Partech Africa. Partech is a global VC fund that manages over 3 billion in assets under management worldwide. For Africa, we manage about 450 million across 2 funds. We're currently deploying out of our second fund, which is a $300 million fund, investing in startups between Series A to Series C, so really like early to mid growth stage. I've spent my career largely in venture capital in the US and emerging markets, and then also spent some time doing private equity in emerging markets. So excited to dig into the topic of conversation today.
Thank you, Lewam. And then Kristin, over to you.
Yeah, hi everyone. Good to be here.
Kristin, for some reason we can't see you. I think the background has eaten you up.
That's odd. Okay. I'm not sure why. I'll figure that out. But just as a quick introduction, I'm with a fund, early stage VC called Innovate Africa Fund. So we write checks, typically first checks in pilot MVP stage companies. Prior to that, and still in some cases, I'm an entrepreneur. I've been building companies for the last maybe 5 years, and before then I was in consulting, mostly management consulting, focused on digital transformation and digital innovation work. I've been angel investing for about 12 years now, and I think it was Stephen or David that mentioned I am also alumna of this program, which I definitely found very insightful when I started trying to invest more intensively on the continent, and it really helped me to get a sense of the landscape. So definitely a plug for the program for any folks that are interested in or considering it, based in Kenya. And yeah, I'm excited to share some of my experience over the last 12 years investing across the continent, as well as in Latin America and in the US as an angel. And what you do when you don't have all the machinery of a big firm or whatever to support you. Yeah.
Thank you, Kristin. And for the record, we did not pay Kristin to advertise the program. She genuinely did enjoy taking part in the program. Tarek, over to you.
Okay, my name is Tarek Kady. I'm founder and chairman of the 2 organizations, the Alex Angels, which is an Alexandria, Egypt founded angel network that has around 70 investors to date from 5 different countries. We have invested in around 30 companies, and we've done 2 full exits and 3 partial ones till now. We have some in distress, which I'm excited to share some details with you. I'm also the founder and chairman of the Mediterranean Investors Network, which is a network mainly around the Mediterranean, but it does have members from North America and Southeast Asia. We have angel groups, VCs, family offices, incubators, and accelerators, and our role is to work with portfolio companies of our members to help them work with corporates or raise follow-on funds, or also partial secondaries and partial exits. These are the three things that we do around the Med. We have around I think 28 to 29 organizations now from 17 countries around the world. And thank you for having me. It's been a long time since I've joined you, and excited to join the discussion.
And thanks for joining. So maybe just jumping right in, of course, for the participants in the session, you can tell why we got these speakers, very experienced, different viewpoints from across the continent. So I'll jump right in, and if you have any questions, just to reiterate, please feel free to type those in the chat, and we'll pick those up and we can ask them. But I have a few questions that I've shared, which I think will just set the tone, and then we can pick out whatever comes on. So maybe let's start with you, Lewam. And let's start with a broader view of just what's your current read of the investment climate? What excites you? What risks are you seeing before we jump into the topic itself?
Yeah, it's a good question. I think last year was a bit of a challenging year for the ecosystem more generally, because there were a ton of macro shocks that happened. Currency devaluation happening in Nigeria and in Egypt. Notably, I think there was a general sense of instability in the market, which really caused a decline in activity and a decline in funding. And similarly, there were a bunch of companies that were forced to spend more time iterating, because fortunately or unfortunately, a lot of the traction is USD based. So even when devaluation is eroding your growth, you're still evaluated on a USD growth basis and metrics. So we saw a bunch of companies, instead of going to market to raising internal rounds, and focused on iterating their business to change sort of the trajectory and growth profile, and a big focus on things like profitability as well. I think coming into 2025, what's been interesting is we're seeing some settling in the market, which is really great. So there's a lot of companies now sort of coming into the market, looking to raise additional financing, looking to raise additional rounds. And on the venture side, there is more funds focused on Africa than there has been in the past. So that's great for us as well. So we don't necessarily need to rely extremely on international capital. So when the pullback happened, I would say even in 2023 and 2024, now with the market settled, we're well placed to benefit from the funds like Partech that are focused on Africa. So I'd say coming into this year, quite optimistic, actually. Last year was definitely a challenge, but this year is looking much stronger.
Okay, thanks. Maybe same question, Kristin, maybe jumping on to you. And from your viewpoint, what are you seeing differently? You invest in much earlier stage companies at MVP and so forth level.
Yeah, and I think the stage that we invest is fondly called the valley of death. So I would say that there's an actually much higher rate of failure than for other later stage investors. And I do know that this is sometimes even the criticism that angel investors face around their willingness to take risk, right? But it does happen to be my sweet spot. I think so. There's a prayer. I'm not sure where it's called, where it's from, but it's called the Serenity Prayer, and it's a favorite prayer of mine. It says, it asks for courage to change the things you can change, right? It asks for discernment, right, between being able to accept the things that you cannot change, and then discernment in knowing the difference between things that you can change and things you cannot change, right? And I think it's a very, very important, mantra for being an angel investor, because the very last thing you want to be is meddlesome. And also, you don't want to expend energy flogging a dead horse. So I think the most critical thing for us when we do a deal is, first off, even just understanding the founder's behavior, right? So, of course, through the diligence process, most founders are pretty responsive. They will, give you whatever you need, and, they'll reach out to you sometimes even in the middle of the night, and all of that. But typically in the, first few months actually following an investment, it'll be very, very clear to you what kind of founder you're actually dealing with, right? You'll see whether you get those investor updates. You'll see how proactive and responsive they are. And those
Kristin,
first
I'm
few.
gonna jump in because you've jumped onto the next part of the conversation.
Okay. Okay.
If I just sort of like just 1 sec, let's read the environment, and then we're coming back to
Yeah.
that bit, and I'll start
Yeah,
with you
that's
in just in a
perfectly
sec.
fine. The point
Yeah.
I was just leading up to was really just that even though early stage investment is called the valley of death, the behavior that a founder demonstrates in the initial stages following getting the check is indicative for you as an angel of understanding where you can and cannot play, and how you may or may not end up being useful for that process. So that was the principal point.
Okay, brilliant. Thanks. And Kristin, I think we may excuse you from using the AAA background so that we can see you. So
Okay,
if
I'll
you
give that a
feel you
shot.
can use a different background, feel free to do that, and then at least we're able to see you.
Okay.
Tarek, from your viewpoint, what are you seeing? What excites you? What are some of the risks you're seeing in the ecosystem at the moment? Yeah.
So, I'm seeing all the AI craze happening now. It's very exciting to see what's going to work, what's not going to work, what's just a big, bubble that I don't think it's going to burst, but a lot of people are going to, just slow down, and everyone's testing all the tools and making sure that the users are, renewing their subscriptions. And AI in general is great. A great example, you can see Kristin's AI here, AI avatar, and just kidding. But the climate tech and all the new startups that are coming up, I think, post 2022 reset, I think it's something important to see things stabilize. This is the exciting and part that is great. But you're looking at, what worries me is still the high valuations that are unjustified in some regions. Lack of follow-on funding is something also that's something that worries me a little bit. Overly depending on external capital for startups. So, but we're seeing more realistic expectations in general. The ecosystem, I think, is still correcting. Excited by everything, of course, happening with AI, as I mentioned. What's really interesting for us in the past year is that we started building some tools to help us manage our portfolio. So we've slowed down on investment the past 18 months, and we've built something that's interesting that we call the portfolio, the startup valuation tool. So it's a portfolio value tool. So it's like a Robinhood dashboard for angels to, instead of monitor their stocks and cryptos, but they're all startups, and monitor their valuations. So it aggregates all the values and monitors all the write-offs. And it's very useful, not for funds per se, but specifically for angel groups that have members that, 50, 60, 70 members or more. Yeah, that's what we've done the past period.
Okay. I mean, I'd love to pick on that, portfolio valuation too, but we'll invite you for the valuation module, and probably we can dig in to that a bit more. But
Yeah,
just
we called it the startup value tracker. That's the right
startup
name.
value tracker. Okay.
Yeah.
Okay. We'll have that in mind and invite you to speak about it, because
absolutely, my pleasure.
I know as you're building your portfolio, one of the key things you want to always know is how your portfolio is doing.
Yeah.
But now, coming back to this, and maybe Kristin, I don't know that you're there. I see you seem to. Okay, Kristin, you're there. Okay, brilliant. We can see you now. We can confirm that it was not
AI
an
is
AI.
progressing. Before it was only audio. Now you can see the video and everything. It's really cool.
Okay, just to firm up that it's not an AI. Kristin, just starting with you then. When do you know that you're getting onto the bumpy road with a portfolio company of yours? Maybe let's start from there.
I think that was even part of what I was saying. It's always the bumpy road. I actually think it's the flag if the road is presented as not bumpy, right? Because it means that you're not getting the full picture. Those early days at a venture are so unpredictable, and there are just so many unknown unknowns, right? And in fact, the hallmark of a strong founder is the humility and willingness to accept that and pivot around that, right? So if the picture you're getting is constantly rosy, is constantly everything's great, we're on track, we're hitting our goals, that's really strange, right? Because that's just actually a stage where you're constantly learning as a founder. In those very early stages, you are running experiments with potential customers, with with users. You're exploring what your product is doing or not doing right, and there's a fair amount of disappointment as well. So in fact, the silence, or the kind of like, there was a portfolio company that basically every update looked the same. It was just like, I think they would just like update the month. And it's like, things are going well. We've grown 5% in the last blah, 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 blah. We're excited to be building. And it's the same thing every month, right? That's actually a red flag. But I think the point here as well is some founders are just sharing information for FYI, right? They don't want you to intervene. They don't want you to step in. They just want you to know what's going on. Some founders are sharing information because they've been told that that's what they're supposed to do. They don't even know how to utilize you as an angel. So I think that part of the work as an early stage investor is reaching out and offering that help, right? Obviously, you have a life, you have a job. For most of us, angel investing is something that we do on the side. It's not our primary form of livelihood. But you do have to figure out a pattern or a routine for being able to reach and offer support to founders and respond when they're giving you updates or they're providing information, right? And it's okay to offer. Sometimes you'll be taken up on that offer. Sometimes you won't be taken up on that offer. But I think there's important work to do around saying, where is this a situation where I probably need to make the founder more comfortable with asking for help? And where is this a situation where the founder is kind of saying, I've got this, I just want you to know what's happening so that it's transparent and there are no surprises. But just from a mindset point of view, I think as an angel investor, it's so important to recognize that failures are part of the journey. Right? But the process of failure is not meant to be a one-off, right? So it's not like, the founder says, okay, I'm building this product to do X, and then it doesn't work. That doesn't necessarily mean the venture is failing or the venture is in trouble. That's actually a normal part of the process. So even as an investor, you're signaling to that founder about what it means that that particular experiment failed is indicative of whether or not there's anything to salvage or not, because perhaps they need to pivot, perhaps they need to approach it in a different way, perhaps they're not seeing something that the customer has actually been telling them. So it's also understanding that failure is not like one point in the process. It's a process. There's multiple failures in the journey, and you need to understand which failure, like you need to know what is what, and not create a sort of doom and gloom environment in what is actually a natural part of the process.
Thanks, and I think that's a good point to start from. We all speak about you create a portfolio. Some of it is gonna work, some of it is not gonna work, and the portfolio then helps to balance out. But then Tarek, maybe coming to you before we move to Lewam. It's all good, and in theory you understand part of your portfolio won't work, but when you sort of like put in cash and the cash disappears, the feeling of it or the experience of it and the knowledge of it is very different in this case. And maybe the question to you would be, and you mentioned you had a couple of investments that you felt, they're not working, they're distressed at the moment. First of all, when did you start realizing? Is it something you had modeled before? Is it something you saw? Are there any telltale signs that we should be aware of? And I do take the point that Kristin was making. The point being that some of it is going to go wrong, and you need to anticipate that. But I guess beyond a particular level, then it means that your thesis from a return perspective, from an impact perspective, then is not true, right? So you do need to manage things, and you need to anticipate things. So, what are the telltale signs? And, maybe before you even start, what do you do at that point?
Yeah. I think this is the foundation of angel in investing in general when we're looking at the portfolios that we're building. So we reverse engineered the returns that we want to achieve. So if you're looking at that asset class, this should return a 25% IRR on average. So in order to achieve that, you need to make sure that you know that half of the portfolio is going to fail. 50% is going to fail at that stage. That's give or take. It could be 40, it could be 60, but 50 is the norm. So if you're looking at 50% failing and you want to get the 25% IRR and get the multiples and the numbers to work within 8 years, then 50% is going to fail. The remaining 50%, I would say 10% is going to give you a 30x. And so 1 out of 10 companies would do that. And then the other 2 would give anywhere between 5 to 10x. This is how you get the 25% IRR, approximately. But in order to get that, my point is, if you need to get a 30x minimum on this, winner, then you need to believe that each company you're investing in needs to be a 30x return investment. And if you look at less than that, then you shouldn't invest at that early stage. This is what we do, and this is how we advise our members to do. And in order to get the 30x return, then you need to be realistic about the valuation that you're coming in. So if you're investing in a company at seed stage that is valued at $20 million, a 30x is a 600 million exit, which is not your everyday exit. So this is, our sweet spot is around 3 to 5, anywhere between 1 to 5 to be realistic. You don't find these ones except in pre-seed, but I mean 3 to 5 mil. And we have to believe in each company that will give you this 30x return, so that you don't know which one's going to make it. So you have to believe that each one. And then the other thing which is important is to look at the portfolio and track that. And this is something that we did not really do as an angel network because we're structured as a club. And I'm talking about Alex Angels now, not the Mediterranean, but this is how we started. 2017, we realized we've invested in all these companies, and we have members that came in that have also other investments, and we need to see how we can manage those, or at least understand how to track the portfolio, the performance, and to help the ones that are in distress. So that's why we built this tool, so that we can, if we want to write off a company from our investment amount, this would aggregate and reflect as if it were a fund. So this is what we're doing, but in terms of tech, and that's what we built. But back to the fundamentals, you realize there are red flags that you see in companies that you need to still help, but you can help in a way. So if they're not communicating, they're shifting the vision, their churn is increasing, customer acquisition cost is decreasing, turnover from the team that is happening without any detailed explanation, or these are things that that should worry you as a portfolio manager or an investor, or overlooking a portfolio of companies. Especially silence is the loudest signal that you can even hear when sometimes things go wrong. So you just need to pay attention on these small things, so that you can step in and see how you can support, and the ways to support are different. And I think we might be talking about that down the road in this discussion today.
Thanks for that. And I like some of those points around the silence, the turnover from the team, shifting the vision, the numbers are not making sense, and so forth. And maybe Lewam, coming to you, And I won't ask you the same question, but feel free to add any other points you want to add. But I guess there comes this point where you need to have the conversation and say, hey, what's happening? So how do you approach founders in a way that at least is seen as constructive, and you're not sort of like attacking them, because at this point as a founder you're probably defensive, you're probably shy. I mean, some of the founders at least I've interacted with, they're going through a certain level of shame. It didn't work out, or things are not working out. How do I come out clean and say it's not working out? I've taken this amount of money from the investors and so forth. So how do you approach that conversation just to be able to get to the point where you can start building a constructive conversation?
Yeah, it's a very good question. I think you do two things. One, transparency is super important, and being direct is super important. But on the flip side, at least for us, because you are usually working quite closely with the company, it's making it sort of a team problem rather than a founder problem. So rather than putting all of the blame on the founder and saying like, what's going on? You did this, you did that, whatever, that's not constructive. More making it a team conversation where you're saying, okay, so it seems like we are struggling on this, and it seems like the numbers or margins are coming down, or the customer acquisition costs, so what Tarek was saying, is going up, or the revenue is a bit bumpy. What's going on? Is it something we can fix? Is it something we can change? Or is it something we have to pivot or iterate around? And how do we react? So I think what I've found, at least in my career, works really well is in that moment when things are not going super great, or when things are quite challenging, it's very isolating for the founder or for the founding team. And so approaching it from a place of compassion and teamwork is important, but so is being direct, transparent, and trying to understand the gravity of the situation as well. So it's honestly, it's a delicate balance, I would say, between the two. And I'm not sure that there would be too much for me to add around what Tarek and Kristin said already, around what the signals are that something's going wrong, but maybe for us, it's a bit different because we're dealing with companies where we're on the board and where we have more regular touch points. So it's a bit of a different dynamic, but I would agree with what they said. If there's no communication, if there's sort of no explanation around iterations, if things are going the wrong way and the narrative you're hearing is completely different to what the numbers are telling you, then that's always a bad sign, or at least that's always a cause for conversation.
Okay. And maybe just sticking with you, I guess one decision that you have to make at that point is, how much are you going to throw at the company at that point to sort of like turn things around, or, at what point do you sort of like cut your losses? Maybe just walk us through that analysis. How do you sort of like go through the motions of figuring out to the point where, let's spend enough time, because I've had it often say that, if it's going bad and it's going bad, at times, the effort to turn that around is better spent in, making your winners become unicorns, as opposed to turning your losers to sort of like your, 2x kind of companies in this case. So just walk us through, how do you think about that decision, and to be able to get to that point where you decide how you're going to act with the company?
Yeah, it's a good question and not an easy one to answer, but I would say from an approach perspective, the first thing to do is to really make sure you can diagnose the problem, like understand what's going wrong. Is it that they lost a major customer? Is it that they haven't been optimizing costs? Is it that something is a bit out of control in the model or the economics? You need to have a very clear understanding of what's going on and what the problem is, so that you can diagnose, is this something that can be pivoted around? Is this something that can be managed? Or is it something that's kind of an inherent risk to the business? I think the other thing you have to take into account is the leadership team and their temperament around this, because there will be instances where, to be fair, going through iterations and restructuring a company is really hard and super exhausting. and really demotivating as well. So you can end up with a team or with a leadership team that's extremely burnt out, doesn't kind of have the energy to keep going, is not excited about turning a ship around, is more kind of ready to leave. Which obviously kind of then underpins there's nothing you can do if you're dealing with a team that's exhausted or a problem that you can't effectively diagnose or come up with a cure. Then you figure out how much does this company realistically need to be able to get on the right path. Is this a number that is feasible for the investors around the table? Again, this is all assuming you have a leadership team that is ready to turn the business around and you've properly diagnosed the problem and really understand what went wrong and what can go right. But there has to be a really strong upside scenario and a good understanding on how much cash it'll take to get the business to that upside scenario. And then finally, ensuring you have enough cash around the table to put it into the business. I will be honest and say most turnarounds don't happen. Like usually the business will go out of business because it is quite difficult to change course of direction when things are going really south. What you see with the really sharp founders, especially with the shift in the funding environment we had, let's say in 2021 to 2022, 2023, is the ones that start to read the numbers early and make the aggressive changes that are necessary. Whether it's cutting costs significantly to restructure the business, whether it's reformulating the growth plan, those are the turnarounds that have the highest success rate. When you catch it extremely early, because then you have bandwidth, you have cash, you probably have runway. It can feel severe in the moment to change direction so much, but that actually has the highest likelihood of success in my experience.
Wow, thanks. And maybe just bring in Kristin here. So just two thoughts. Of course, what I'm getting from what Lewam just mentioned, there's different types of distress. There's some that's probably, this is gone. There's different levels in terms of at what point you sort of like pick this up and what can you be able to do that. And maybe just bring you in, Kristin, and roping in the question Abdullah just asked. So you're not getting, any input from updates from the startup. So you're not getting a good sense of what's happening, which of course means that you can't diagnose the problem as early as you'd like to. So first of all, how do you get the information? But then, from an angel's perspective, I guess at a VC level, you're investing in companies which are maybe Series A, they have a decent runway and so forth. And they know what they're doing. They figured out the problem market fit. But at angel level, right? I would imagine that things are more chaotic at that stage, right? So how do you make the same kind of decision? And then as you respond to Abdul's question.
Absolutely. So for Abdul's question, I think the first thing is if you don't get regular updates, I think the first step is even just establishing some sort of rhythm, because that's really important. And the rhythm doesn't have to be best practices. What I mean by that is ideally you want to be hearing maybe every month, right? But maybe if you're going from zero or irregularity to something, maybe you want to start off with once a quarter or every 6 months. Hopefully they're willing to entertain once a month, but at least creating some sort of regularity and some expectation of, okay, if I don't hear from you in a kind of comprehensive and helpful way by, this date every quarter, then I know to reach in and step out so that it doesn't feel like one, you're interfering. Because the thing is that mindset is such a critical part of the founder journey. Your founder needs to have the audacity and the confidence to feel like they can surmount whatever challenges are in their way. And as a result, if they are going through a difficult period or they're burnt out or whatever, it's important that you're stepping in a way that doesn't feel like is maybe an expression of a vote of no confidence or that undermines them in some way, because that just makes the situation worse. Sometimes the team is just burnt out, right? Or they're sad, quite frankly, because they've had a series of failures. Especially if you're in a B2B business, you have a long lead time for conversion. So sometimes you spend 8 months or something chasing, and then it falls apart at the last minute. It is heart-wrenching. And sometimes you don't quite even know how to even communicate this to an investor. So maybe you skip an update here, and then things have gotten a little bit worse, so you don't have good news to share. So you skip the next update, and then before you know it, you haven't sent an update in 3 months, right? And then now you're not only ashamed of the failure with that big deal that you were riding on, that you sent 6 previous updates about how the progress was going, you're also now feeling shame about not having sent those those updates in the last 3 months. So how that angel investor intervenes is so important. Checking in, how are you doing? What's going on, right? Just a conversation, right? And then trying to re-establish that rhythm of regularity, because you need that regularity so that it's a reference point. That if I haven't heard back in a quarter, I know to be worried. I know to step in, right? This is our social contract. So that's number one, is creating that regularity. And then the second thing that I would say is asking pointed questions, right? So as much as you understand about the business or the experiment or whatever it is, it's important that you are being clear about showing that you are you are invested, right? Not just with your cash, but with your appreciation. Because if your questions are also super generic, that's a signal to the founder as well that you're not really interested or whatever. Does that make sense? So these are the things that are really important. You check in, you ask how they're doing, you try to get a sense of headspace, you try to create some regularity around when you should be getting updates, and then ask pointed and specific questions that reflect your interest and investment in the business.
Yeah. No, thanks. And good points. One thing I would do with founders, especially when we started out on a deal, is just have coffees every month, right? And I just found I would get much more from that than from sort of like the updates that they would send at the end of the quarter. And I think that's an easy way of just sort of like, being friends, and someone can tell you what they're going through. Tarek, I'm going to have to shift gears. I feel like we've started a conversation and we're about to finish the conversation, and we've not even gotten to some of the bits that I think would be really fascinating. But Tarek, let me just jump towards the end a bit. So what happens with the distressed investment? I mean, the fact that it's distressed doesn't mean you don't want to get your money out. You do want to get some money out, because every shilling, every dollar counts in terms of your final return, right? So do you just say, okay, we model these, it wasn't going to work, or do you engage debt collectors and say, we're going to get every last bit? How have you handled this kind of situation? Tarek,
yeah, I'm now unmuted. A very good question, and as much as you have your model already preset and you know what you're expecting, but you still need to intervene. You're not just throwing in your money and waiting for the results. So there are things that work and there are things that don't work. I think the first important thing is to, once the founder realizes that there is a problem, and this is when we need to talk, because some founders do not realize the problem, and this is when it becomes important. But I'm just going to go through some of the things that we've done that have worked with the team. So we've worked on realistic turnaround plans. Is there a realistic turnaround plan to the situation? We can also bring in some experienced advisors, or maybe some interim executives that can come in to support in financials or whatever distress lies. Funding is also important, but without without a solid plan, then it doesn't really make any sense to put follow-on funding. Also, you can explore partial exits if something is, we do the partial exits in general as a strategy to realize returns, but not at a distressed situation. So we do partials that are structured. So we sell 30 to 50% once a founder is raising capital and he has already secured the amount from an external investor who wants the secondary to want to have stake in that founder. So it doesn't work when startups are distressed, but when we're looking into, cutting our losses, it might be a good thing to, just, call it off and sell whatever can be sold, but that's the last resort. Pushing for a pivot or rebranding and acqui-hire could be something that also works in general. At the end of the day, you're not driving, but you're still in the back seat and you're seeing and trying to help. So the founders need to be doing all these work. We're supporting them at that stage. What doesn't work is just, putting in more money without a plan. That doesn't make sense at all. Being over-involved or micromanaging or over-judgmental doesn't work. Ignoring the red flags doesn't work. and letting emotion take over has also been a big mistake that we've sometimes done. So it's all facts, all numbers. These are the things that have worked in most cases. And success has really been a big turnaround. It's maybe 20-30% of the times that you're trying to help, it has worked, but at least saving 20-30% of the portfolio is better than nothing.
Yeah. And maybe Lewam, same question and a different angle, which is, for those that have worked, maybe I should ask two questions in one. I realize that I did not ask the question of what is a distressed asset. So we've been working on the assumption that we are all clear on what we're talking about. So maybe just you can share with us what your view is on what a distressed asset is for you. And then as you're sharing that, you can also just share for the ones that you've been able to turn around, what worked? Because that's a really important point for angels to pick out.
Yeah, it's a good question. I'm sure everybody will have a different definition of what constitutes a distressed asset, because it feels like almost a philosophical question of when does an asset become distressed. But I'll say maybe more loosely how I would look at it is a company that is running out of cash, struggling to grow, struggling to prove anything from an economics perspective or from a traction perspective, and maybe even deteriorating in terms of margins, potential, customer acquisition. So I think it would be like hard things like cash, and then the traction prospects declining as well. And to the question of how do you know, or what does it look like, or what works, I guess, in the restructuring, I think you really need a founding team that is ready to bite the bullet and is ready to aggressively change course, which is tough because for founders, the companies they build, the products they build, there's an emotional attachment as well. And they get so excited and they're so bought into what they're creating. Sometimes even when it doesn't work, they still want to give it like more time. They still want to try harder. They still want more leeway, and feel like maybe the timing isn't 100% right. One day it'll be 100% right. But what we've seen is the founders that are so hypersensitive to responding to what the market is saying are the ones that have the highest chance of success, because they're iterating based on the customer, they're iterating based on even conditions like how much capital is flowing in the market versus not flowing in the market. They're iterating the product to move towards positive unit economics when needed, or to move towards acquisition when money is more free flowing. But yeah, so I guess if I had to summarize, I think the biggest thing is really the founding team and the founding team's ability to really aggressively change course. And nothing can replace that, because as an investor, especially as an angel investor, but even as an investor on the board, you can advise, you can push, you can advocate, you can warn, But at the end of the day, it's the founder that is the one running the business. So if they can't see the writing on the wall, if they can't see the need to shift, and if they can't make that transition a bit ruthlessly and aggressively, it becomes quite challenging.
Yeah. Wow, we are running out of time. I have 2 minutes. I'm gonna skip time by a few minutes, depending on how long you respond to the last question. This is the last question. I feel like we need a part 2, but that's why you should join all the Angel Connect sessions, because they are always this good. You start and you feel like you've not gotten the juice out of that. But my last question is gonna be this, and I'm really struggling on which one is the best. But what's the biggest lesson you've learned from a failed investment? And the twist to that then is there anything you could have done differently to avoid that? Because we all want to get the perfect portfolio. We know it's not possible, but we should optimize for that, right? So Kristin, I'm going to start with you, and then Tarek, and then Lewam, you can close for us. Kristin.
Yeah, so I think for me, the biggest lesson, and it's hard when you're not a professional investor, right? But I think the biggest lesson is really just dedicating time to read, to follow up, to engage. There are almost always signs, but obviously because you're busy, because you have things going on, you might have missed them. So I think the biggest lesson is really paying attention. And you'll notice that I've kind of focused on the things that an angel can do. There's lots of parameters that are outside of your control, despite your best efforts and all of that. And so I think it's really just important to do what it is that you can in fact do.
Thank you. I like that. Tarek?
I think the biggest mistake that, most either founders or investors do is fall in love with what they're doing instead of the problem itself. So for founders, they need to, be obsessed with the problem, not with their solution. And at the same time, the investors need to be pragmatic about what they're doing, not to just go jump in with what they're passionate about and what they, prefer or what they like to see without factual observation. I think these are the most two important lessons I've seen as a founder early on, and then also investor.
Okay, thank you. Like that, straight and sharp. Lewam.
I 100% agree with what Tarek said. I think that is absolutely the biggest issue, especially on the founder side, or can be the biggest issue. But what I would say is maybe something a bit more practical on the side of what can you do, or what will give you the biggest chance, or what mistake have I seen that founders make that kind of costs them something. When things are going wrong, there's a clock that starts, and there usually is a lot of confusion around what's going wrong, how do you change it. The biggest priority when the clock starts and it's clear something is going wrong, like drastically wrong in the business, is to cut costs aggressively and buy yourself time. If you're able to buy yourself time, you buy yourself a better chance at being able to navigate the problem, at being able to pivot, at being able to reiterate something or iterate something. And I think this is the scariest and hardest thing for founders, because the last thing you want to do is like fire people or restructure or something. And it's really challenging, right, to go through something like that. But the truth of the matter is, as soon as you know something is wrong, the clock starts, and you just need to be really aggressive in giving yourself the most amount of time to restructure the business. That's not 100% success rate, not to say that it works all the time, but in the instances where it's worked, it's the founders that have been able to do that so quickly, so intelligently, read the room, and were ruthless about it.
Thank you so much. This is an amazing conversation. I wish I had another 30 minutes or an hour to just keep peeling the onion, because I feel like we've just started out. If I had sound bites for this conversation, the first one would be, distressed assets are gonna be part of your portfolio. So plan for them, expect them, but of course that doesn't mean accept them, but plan for them at least. Then the other soundbite for me would be, dedicate time to find out, what's happening, keep up with the founders and so forth, so that you can be able to figure out when things are about to go wrong. You can be able to support. And then the other soundbite for me would be what Tarek just mentioned about not falling in love with the solution, but the problem itself. Because there's all that passion, you've created this amazing thing, and you focus on it, you forget that you're actually solving a problem. And then Lewam, I don't know which one to pick, but I'm gonna pick the clock. The clock starts ticking, and the only way to buy yourself time is being aggressive in terms of cutting costs and giving yourself a bit of time to be able to breathe and figure out what solution could be. Thank you very much for joining us. This has been an amazing conversation. I wish we could have a part two. Maybe we'll have a part two. But for the participants who are also able to join us, we appreciate you. We'll have the recording shared out with a few sort of like bullet points in terms of what we picked up from the conversation. And I didn't ask the speakers to share their contacts. If you can, maybe you can drop in your LinkedIn or something if someone wants to connect with you. I think that would be awesome if they want to follow up on any points that you put out. Otherwise, we'll just pick them up and we'll just add them as part of the email you share out. Thank you and do have a lovely evening. Apologies for going over time. Conversation was too good to stop on time. Have a lovely evening.
Thank you so much, Stephen. Thank you, everybody.
Thanks, everyone.
Thank you for having us, and thank you for tuning in. Looking forward to joining again.
Thank you very much.
Hi.
Stephen, thanks for moderating. Thanks, everyone, for joining. See you soon.
Thank you.
Thanks,
Yeah,
everyone.
see you. Bye-bye.